Hey, welcome back. Despite the stock price being up a lot in the past half a decade, BYD might still offer a lot of potential. They expect record profits once again with an 80-something% jump in earnings last year despite having a smaller profit margin. They have a very significant market share when it comes to EVs, especially in China and the rest of Asia. This, which is a result of the relatively friendly environment, allowed them to develop a lot lately and, as you are about to see, keep investing massive amounts of money. There was a very significant decrease in the production in February, but the sales volume is down only a bit. But the global expansion is only beginning, so there is a lot of potential. Unlike many other EV companies that are popular today, this one is close to 3 decades old, has the production capacity and is diversified into railway systems, solar batteries, electronics and a variety of vehicles, especially buses. They are very big when it comes to electric buses, already having a strong presence in Europe and the US. But on the other hand, you have bans from the public sector because they come from China, but more on this in a bit. Now, this company has seen some very significant growth recently, and with the capex going up like 12 times since 2020, there is likely a lot more growth to come. The cash flow from operations got to 20.5 billion, which is similar to what Stellantis can make in a decent year. So, with normal capex, this company could make 10 or maybe even 15 billion in free cash flows today. For a market cap of 70 billion, that would be a very attractive ratio, and you also have to take into account the potential to grow because they are investing so much. But this is during a relatively very friendly environment, which may not be like this forever, but more on this in a bit. Comparing it to NIO, for example, which has been losing more and more money from operations, meaning that there is a significant problem there, BYD is doing very well. In case you care about this kind of stuff, Warren Buffett bought this in 2008 but has been selling his stake over the past years. Now, this doesn't make it a good or a bad investment, you have to think about it from his perspective. You know, when you make like 30 times your money in a bit over a decade, you taking the profit from the stock doesn't necessarily have to do with what you think about the company. They have current assets of around 38.3 billion, I'm converting everything into dollars by the way, which is not enough to cover the 58.5 billion in current liabilities. This can be a pretty big problem and it can result in them having to issue debt. The non-current liabilities are much smaller, less than 9 billion, which is very good, especially since they have 48.5 billion in non-current assets. And look, I'm not saying they are doing anything, but keep in mind that this is China and you can't have just any company do the auditing for you. And yes, China is theoretically opening the books a bit, but this is gonna take time and until then you can still have a few issues. By the way, I even found a potential mistake in the latest report where they attributed the growth in intangible assets to land acquisition. Land is a prime example of a tangible asset. I thought maybe they meant that they got some kind of intangible assets like goodwill as a result of purchasing the land, but the goodwill is reported separately and it didn't change. And it can't be permits and stuff like that because that's included in the value of the land. You know, this is a 1.25 billion difference, it's not a few million. Even though you may see the big four accounting companies there, they are Chinese subsidiaries and it wouldn't be the first time they do something bad, but let's say they are fine. The current liabilities are quite a bit of an issue because that 20 billion difference is not something they can just make in a year. It's very likely to see them issue some long-term debt, which is not necessarily bad, but at this rate they might even have to slow down the production to avoid having to issue too much debt. You know, it's really a matter of management. If they manage it right, it's really not that big of an issue, because if they get some debt and issue some shares like they normally do, it's just a matter of timing of the payables, inventories, receivables and so on. If you ask me, they should have issued a lot more shares back in 2021 to 23, used that money and could have been totally fine today. Sure, the stock would have probably been lower, but think about the long-term benefits for the company. If they issued an extra 5% of the company per year during this time, they could have been not only debt-free but theoretically liability-free, which would have been quite unique in the industry. In that case, at this price, they would have been an instant buy. Not to mention that the price would have been even lower as a result of them issuing stocks. The alternative is having to issue them now or getting some expensive debt, or both. Now, as much of a risk as Chinese companies are for the big American and European ones, a very significant risk that so far has been beneficial for the company is the Chinese government. We saw how much they can influence the market a couple of years ago, and if they stop the subsidies, for example, this can really hurt most of these companies. These plans for subsidies are not unlimited. There is the recent example of solar, and even a year ago they stopped some for electric vehicle purchases. Not only that, but international politics can also be a big issue, especially when Europe is done with the probe into Chinese car manufacturers this year and maybe even add some very significant tariffs. They want to open another factory in Hungary, which could be the beginning of the expansion into Europe, but there is still political risk. Now, don't get me wrong, there is good potential, but I also want a margin of safety. They may have an advantage today, but we have to keep in mind how the market may change even in half a decade from now, especially when big companies are investing so much more money and have originally planned to scale the EV production from about 2025. Price wars and the growing competition are great examples of how the market can degenerate into a terrible environment to be in. If this continues, it's very uncertain who would even win, and this can rapidly fall to a 10-15% margin industry like the traditional car industry. In this case, I think it's very important to have good financials and already have a well-established production capacity, because as a small company, you'd have a terrible time if the margin is affected. And again, subsidies won't last forever, and if Chinese companies don't build a strong position with them, they'll have very big issues without them. This is why I'm saying that BYD should have issued much more than they did, but I don't think it's too late for them to improve. As for a valuation, this is going to be a bit tough to do since they are growing so much and the environment is in a pretty significant point. A lot is changing, so estimating this is even harder to do. In a bad scenario, let's say we see no more subsidies and help from the government, tariffs in Europe, restrictions, competition, and so on. They could probably still make like 5 billion after they finish investing so much and settle to a certain level together with the market. For a ratio of 10, that's a market cap of 50 billion for a price of 26.2, so around 50% less than today. Now they can still develop a nice position in the rest of the world, so maybe it won't be that bad. I also want to mention the bad scenario where there are some accounting irregularities and you basically risk losing everything as a shareholder. This is a pretty old company with experience and stuff, so I don't think it's too likely, but we have to keep it in mind. Plus, by default, a recession in this industry is a 50, 60, 80% crash or even more, no matter the company. I mentioned this in the Stellantis analysis, so make sure to check it out as well. Now, why I say that this is tough to estimate is because we don't know how much they need in capex to stay afloat. Will they need 5 billion or 15, 20? Not only that, but the cash from operations, not counting the growth from investments, will be lower in half a decade because they won't have the same margin. Assuming that they make 10 billion per year, for a ratio of 12, that's a market cap of 120 billion for a price of 78.72. That's a roughly 50% profit. Now, if they manage to grow and let's say double the business in half a decade, they could even make 20 billion instead. For a ratio of 15, that's a market cap of 300 billion for a price of 196.8. That would be a very attractive 270% profit, and that's for a ratio of 15. If we see a recovery in the demand for Chinese companies and everything is going well, this ratio can be 20, 25 or even more. I think this 20 billion is reasonable because if they got to 30, 40 or more in half a decade when the market is more mature, they would be market leaders pretty much everywhere with 20-30% market shares, and that's a bit much to assume. Now, I'm always using conservative price to free cash flow ratios because I don't want to invest based on market hysteria, but keep in mind that Tesla, for example, after falling in half since 2021, is at a ratio of like 120. This valuation is very similar to Stellantis's, but the difference is, I think, BYD has a higher potential to grow, but Stellantis has better financials. Taking into account the risk and potential, I think this is a good price. However, this company is valued the same as Stellantis or VW, which are 2 or 3 times as big from any point of view and are ramping up the EV production. Taking a snapshot of the EV market right now and making decisions based on it is not a good idea because in not even half a decade from now, the market may be very different. Still, at the current price, BYD is pretty attractive and it could be a good way to diversify into growth. For now, I'll add it to my watchlist and do some more research. As always, what I cover in my videos shouldn't be enough for you to make any investment decisions, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching, and I'll see you next time.